Okay, we are back, chapter 7, and we are on page 3. We're just going to complete the unearned earned profit schedule or one of the other names. Intercompany profit schedule, realized unrealized profit schedule, something like that. So, we need balance, 40% tax, and after tax. Okay, and again, remember, we're assuming just regular tax, no capital gains or anything, or losses. Remember, if we're speaking about gains here, it could be losses. Okay, so what's actually happened in year 5? The sub has sold equipment to the parent. So that means we have an upstream. Is it a gain or a loss in this case? The sub bought it for 3 and sold it for 5. So it's a gain on equipment. So this is year 5. What's the balance then? The gain, so 2,000. 40% tax is 800. And after tax is 1,200. So this is identical to the land, okay, that we did right at the end of chapter 6. So what I want you to do is put this on pause and fill in the accounts and the arrows that you're going to need here. Okay? Because this is just like land, except it's equipment. We're just doing a gain. And then come back and see how you did. So the gain needs to be, that means net income is going to go down. And if net income goes down, what happens to income tax expense? It goes down. Now, think of it this way. On the subs books, they have a gain on the income statement, right? But on the parents' books, what do they have after this transaction? They have equipment at what balance? 3,000 or 5,000? 5,000. Okay? So, if we're pretending this transaction didn't count, then we're not going to have a gain, right? We've got to get rid of the gain. We also have to decrease this down to the original price. Next I should put. Okay, when the sub bought it, brought it into the circle. Okay, so the subs have a gain. The parents' books, their equipment says 5,000, and if it didn't happen, it should be down to 3,000. Okay, everybody good with that? Okay, so that means my equipment has to do what? Go down. My DIT does the opposite and goes up. Are you guys all good with that? Okay, so that was just like the land. Just going to move that over there. Okay, so now the question is, well, the parent has equipment at 5,000 on its books. If this little transaction didn't happen, in the circle, the equipment should be worth 3,000. So, thinking to the income statement, the parent recorded the depreciation or calculated it based on which number? well, the 5,000, right? But for the circle consolidation, it's totally right on its own books, but for the circle it should be 3,000. So that's what we're going to look at now. So we're going to put year 5 incremental depreciation. Okay? So on the parents' books, what would they calculate their depreciation at? 5,000 divided by 5 equals 1,000 per year. Everybody good with that? So remember, the parent has it at 5,000. But the historical value in the circle is going to be equal to 3,000, what it came in at, divided by 5, which is 600 per year. Okay? And I'm just going to underline this so you know it's a title, because there's calculations. So, is this too big or too small, this $1,000 a year? Well, is this 5,000 too big or too small for consolidation? It's too big, right? That means this is too big. Instead, it should be 600 a year. So that is called the difference between those, that's incremental, equals 1,000 minus 600 equals 400 per year. So incremental just means the extra, the leftover. So now, it's too high, have to decrease depreciation expense and accumulated depreciation. So let's put our balance in. Sorry, we had to jog over this way a little. So our balance is going to be 400. That's our incremental depreciation. Our tax is going to be 160. And our after tax is going to be 240. So now, of course, you guys, you could also just take 5,000 minus 3,000 is 2,000 divided by 5 gives you 400. Okay, I'll just put a little or. 5,000 minus 3,000 divided by 5 is 400 per year. Okay, so you can do it that way. Sometimes they'll just tell you the difference and you have to divide it by 5. But every question's worded differently, so the more you do, the better off you'll be. Okay, so now the important thing. What are we trying to do to depreciation expense? Make it go up or down? Because this is the critical part. Well, if this is too big and this is what we want, what do we have to do to depreciation expense? Lower it. And that's going to make net income do what? Go up. And that means income tax expense goes up. Now, if depreciation expense goes down, accumulated depreciation also has to go down. And DIT will do the opposite. Whoops. We'll do the opposite and then I show it the wrong way. The IT is going to go down because IT went up. Does that make sense? Well, hopefully it does. Sometimes, though, you have to think of it. And some people, make little rules. Now, what you will see here is these are going to be opposite directions, always. So if this was going up, this will be going down. Okay? So that's one little rule I can give you. But it's important to think it out, because the more things you add, like once you get into CPA and you're adding the bond holding stuff, then you're looking at something completely different. Okay? So now let's go on and do year 6. So this time it's year 6 and we want the same thing. Balance, 40% tax, and after tax. Oh, and just as a reminder, I just want to go back and remind you that these 2 columns are for the statements and these are for the calculations. Okay, now we go to the next year. So it's year 6. Did they actually sell the equipment upstream in year 6? No. So there's no gain in year 6. But we do need year 6 incremental depreciation. So we've already calculated up there. We're using straight line. We always questions. It's going to be 400, 160, and 240. And that is year 6, so it happened in year 6. So cover up the top, put it on pause. Maybe you should put on pause first, then cover up, and then do the arrows and see if you can get them. And then come on back. Okay, so incremental depreciation was from a gain. So whoever had the gain on their books, in this case it was the parent, their depreciation expense is way too big. So we pull their statements and the sub-statements. Well, we look at depreciation and it's too big because they're using 5,000 when in the circle they should only be using 3. So it's too big, so we're going to make depreciation expense go down, which makes net income go up, which means ITE goes up. Accumulated depreciation goes down, DIT goes down. So hopefully that's what you did. You're doing that the exact same thing as over there. Now, that takes care of what's actually happening in year 6 on the income statement. However, in year 5, did these things go away? Did the parent change their books and go, oh yeah, I should have used 400? No, that was just in consolidation, right? So there's still some effects here that need to be carried over into year 6, but they won't be on the income statement. So let's just like with the land, we had a gain 1 year, and then the next year you didn't have the gain anymore, but you still had to lower the value of the land, or if it was a loss, increase it. So same kind of thing. So now we need the previous years that affect, or that will affect, the cumulative amounts. So that's balance sheet, retains, and NCI on the balance sheet. This is balance sheet. There we go. Okay. So we have a year 5 upstream gain on equipment. Okay? And this is just like our land. So the gain is still 2,000. The tax is 800, and 1,200 is after tax. So, is there a gain on the income statements? We are in year 6. So gain, it was last year. So is net income going to change? Nope. And that means ITE isn't either. Now, if you want to remind yourself, net income used to decrease. When you had a gain, you take it away, it would make it decrease. Because that means ITE normally goes down, which means DIT would have to go up. And equipment still has to go down. Okay, everybody good? Okay, now let's do the year 5 incremental depreciation. So, it's the same as we did up here, the 400. 400, 160, and 240. Now, is the incremental depreciation from year 5 on year 6 income statement? No. So there is no depreciation expense to adjust because it was from last year, which means net income doesn't go anywhere and ITE doesn't go anywhere. So net income with this accumulated depreciation used to go up, so the opposite. So I'm just going to put that in. Net income used to increase last year. So we know that would have increased, which means DIT would have gone down. And accumulated depreciation also has to go down. So, notice on these ones, because they're from year 5, no income statement accounts are used. Okay? So, for these calcs, you wouldn't use anything with net income in them where it's not changing. So you would use it for retained earnings and NCI on the balance sheet. Well, let's write that down. And these two numbers are for retained earnings and NCI sheet calcs. Okay. So now let's calculate NCI at the end of year 6. So we're doing end of year 6, and remember it's cumulative, and after tax. Okay, so NCI equals NCI percentage times subs common shares plus subs retained earnings plus or minus ending balance of changes in AD plus or minus unrealized realized upstream. So that's going to be 10%. Remember, this is at the end of year 6 times 9,000, which if you go to page 4, you'll see the end of year 6, and we're looking for the common shares and retainers. So 9,000 and 6,700. Plus 6,700. Now, you're going to have to look back at page 2. Ending balance of changes in AD plus 2,750. Okay. Now we need plus or minus the realized, unrealized upstream. So look at our year 6. And which column do we use? The after. So 240. Are we going to add or subtract that? Well, we're making net income go up, so we're going to add 240. And net income goes up on that. And that is our year 6 incremental depreciation. Now remember, this is cumulative, so we also have to take into account year 5. So I'm just going to keep going down. So this 1,200, should we add or subtract it? Well, net income used to go down because it was gain, so we took it away. So we're going to subtract it. Okay, and that was a year 5 gain. And then we have this 240. And should we add or subtract it? Well, net income used to go up, just like net income used to go down here. That's why it's negative. So we're going to add that little guy. And that's our year 5 incremental depreciation. Now, broke it all out because we only had 2 years to show. But obviously, if they sold equipment in year 3,